Good afternoon, everyone, and welcome to a Victory Square Technologies CEO Q&A investor webinar with CEO Shafin Tejani. We're just going to give it a few moments while we let everyone join from the wait room. So just give us a few moments here. I just want to make sure that audio is okay. So just if you guys can just give us a thumbs up in the chat, that would be great. If you have any questions, please don't hesitate to put them in that Q&A section down below, and we'll get to them. I know there's a lot of questions that were emailed in, so we'll be answering those. And this will just be a straight Q&A, answering any questions that you have. So feel free to start populating them in that Q&A section, and we'll give it about half a minute and then begin.
Yeah, thanks everyone. Happy Friday. We had, I think, over 50 questions sent in, and hopefully we'll try to get through as many of them as we can. So we'll just, in all fairness, we'll just go through them in sequence, and whatever we're not able to answer on the webinar, we'll answer and post up on the Discord channel, hopefully over the weekend or on Monday. So yeah, thank you everyone for sending in those questions. Just a note before while we wait to get started. It was really nice. Vahid Shane, who's the CEO of Hydrate, and I were at the Planet Microcap conference last week in Vegas, and it was the first kind of face-to-face conference since after COVID. And it was great to meet some new investors and some old investors. We got to meet some investors in VST, which was really nice to spend some time. It'd be curious to know where our investors are generally located. If they're Canadian, are they in British Columbia, Vancouver, or Toronto? I think it'd be nice. It was just really nice to have a in-person meetup with and meet some of the investors face to face. So if there is anyone in Vancouver or in Toronto or in that area, let us know, because we generally will be spending time in those two areas to take meetings. And so it'll be great, when we're in those areas to meet face to face. So. Well, let's get started. Again, lots of questions, and it was suggested that we go straight into the questions. So no intro. If anyone's new, we'll hit them up later and let them know, or send them to victorysquare.com. But I want to get to the questions now. So first question, are there any companies within the VST portfolio trading at or above their fair value? If so, which ones? So the only VST companies trading at fair value would be the private ones. So the private companies in our portfolio are valued at about 42 million. And those are reviewed by a third-party pricing agency and our auditors. In some cases, they're management reviewed, but in the majority of them, like the larger numbers, are all audited by a third-party pricing agency or evaluated by our auditors. The public companies in our portfolio are probably trading at around a 90% discount from levels in 2021. And they currently make up about 23.5 million of the NAV. And over the next period, they may not reach their 52-week highs, but we do think that they'll stabilize, and some of those public companies are trading significantly lower than what their true value is. Second question, what would the NAV be today if the companies reach the fair value in the markets? Would you say that 14 cents is relatively a safe entry for VST? And would you say a fair value, and what would you say is a fair value now for VST? So with the current NAV of approximately 75 million, and I think we have just under 100 million shares out, that would be a share price of roughly 75 cents a share. When we look at our forecast for what we're anticipating ending 2023 with, and that's only including growth in Hydrate, we have our NAV at around 127 million, which would put that around $1.27 a share. But again, that only takes into account the growth of Hydrate. I definitely think 14 cents is share is a great entry point. However, like I've said, my preference, I would like investors to take the time to learn about VST first. Speak to management, speak to investors on the Discord channel before diving in, because we've always been in control of the operations of the company. That's kind of our, we're builders. and we're confident we'll hit our goals with the operational side of the business. However, we can never control the market, and that's where I think we've seen a lot of volatility in our share price over the past couple of years. For us, though, in the long term, we know the market will price us accordingly, but in the short term, it's anybody's guess. So for us, it's really important to have the right investors as we climb back up. So I think it's a great entry point, but I would suggest investors take the time to talk to other VST investors on the Discord channel, listen to the webinars, and learn about the story so that they understand kind of what the business is about. Next question: why would anyone purchase NERS, or which is referring to the ticker symbol for Hydrate? Why would anyone purchase a Hydrate share when they can get the same Hydrate ownership plus more companies for VST shares for less money? Will this kind of disconnect in value last long? The VST story has been harder to understand for some investors because it takes time to learn about more than one company. And for some investors, it's easier to follow an individual company because you can identify what those KPIs are for that one company and follow it on its performance on a monthly basis much easier, and also market to peers within its industry. A couple of reasons why we spun out Hydrate, ticker NERS, NURS, was we weren't seeing the value in VST, so we thought that it would unlock value in VST by spinning off Hydrate as its own public company. We also thought it would bring new eyeballs to the stock, to VST, as some investors would in evaluating Hydrate and be looking at Hydrate again because it's one company, maybe in a sector that they cover or follow, and then learn about VST as a byproduct, and get to the same conclusion which you inferred, which is if you're interested in buying Hydrate, VST is a great alternative to get exposure to Hydrate, as opposed to in addition to other shares of other portfolio companies, or being able to invest into both. The other one, which is a really big point, is that we can grow Hydrate larger, and in doing that, it benefits VST as we own 73.2%. Hydrate is its own public entity, can conduct M&A, raise capital to grow without diluting VST, and especially at the share levels right now, we wouldn't want any dilution with the VST share float at these levels. One other note, just this is my own personal opinion, and this is kind of how we framed and built Victory Square, is that I prefer the portfolio approach, and even more so in the microcap space. Anyone that's followed the microcap space for a while has seen that the failure rate is high, and I think it's like in the 90% rate of microcap stocks that fail. But investors continue to invest into the sector because if you get it right, the wins can be significant and the returns can be significant. So with the portfolio approach at Victory Square, investors have a number of chances to get it right, but with one stock. And we can also mitigate the risks by building an ecosystem of complementary assets, tech, and people. Question 4, will we eventually be getting our shares of Hydrate and Ternium still, or is that going to be discounted in favor of a cash dividend? There's actually a couple of questions that I've kind of grouped together that are all referencing this. Second to that is, are there any dividends in store for VST investors this year? And share dividends have been problematic. Example, effect on share price, commission fees to trade a small quantity of shares for cash. There was mention of a cash dividend in the future. Can this be confirmed as the approach in the future? And is it possible that a dividend would be given this year? So the dividend strategy, was to benefit VST shareholders and also to help build a shareholder base for our spinoffs. We like the dividend strategy. Me as the largest Victory Square shareholder, I intend to hold my Victory Square shares long term. So the idea of a cash and or share dividend is a good thing, and it's a welcoming thing. But I think given the trial run in 2021 on the share dividends that we gave, and I think obviously there are there were issues out of everyone's control. The market was kind of in a downward trend, and the companies hadn't been listed long enough to kind of build their shareholder base. I think that for this year, I don't anticipate a dividend this year, but we will reassess it at the end of the year. And there are a couple of reasons. One, I think given that the market has been down, we really want to build up the foundation of the companies that are currently public, before again giving any sort of share dividends. And also from a cash dividend perspective, we don't want to sell any of the positions when they're trading at 80-90% discounts to where we think they can be trading. So we would rather do that, maximize value, and then issue a dividend, which I think is better for the company and for the investors long term. But as an example, in our plans, like the goal with Hydrate over the next couple of years is to grow it to $100 million in revenue, and then to look for a potential exit. And we've been tracking since we purchased it in 2021. If you go back to 2020, we've been tracking this, what we call a triple, double, double. And that's a growth in revenue over that time span. And when you're able to accomplish that, you're able to maximize the multiple that you can get on the business. There's obviously a number of other factors that are very important as well, but certain positive growth metrics can especially in this sector, can lead to that. And so in order to continue to grow at that pace, we've identified, some can be organic, but we've identified some strategic M&A targets that can help further accelerate that. So in the case of Hydrate, it's important to keep a tight float of shares, because we may want to use shares at a premium currency to roll up some of those M&A transactions to accelerate the growth. And the quicker and swifter that we can grow the business, the bigger enterprise value we can command in an exit, and that would bring a cash windfall back to VST to be able to distribute to shareholders. So in order to maximize that, we have to be really strategic with that. So to answer that question, we believe in the dividend strategy. I don't anticipate a dividend this year, but I think we'll reassess at the end of this year. But I would anticipate one coming, whether it be a share or cash dividend within the next 2 to 3 years, because unless the market stays soft for a number of years and we're not, we don't see that exit opportunity. But based on our current plans, I would expect one within the next 2 to 3 years. And every year we'll reassess it, and every quarter we'll continue to answer that question, and we'll give guidance to shareholders on how things are going with that. Does VST have a strategy to increase book value over time? Yes. I'll highlight three. There's a number of ways, but I'll highlight 3 ways right now. One is the growth of Hydrate. We think that, and I alluded to this earlier, this year, we think that Hydrate and the trajectory they're on and what they're tracking for is going to unlock significant, value on VST's assets. So that's one. And again, we're very hands-on in that. So we're tracking that, very, very closely. The second is the increase in the value of the existing portfolio. Like I mentioned earlier, a lot of our publicly traded companies are trading at close to 90% discounts. And, they may not get back to where they were in 2021, but we do believe that they are significantly undervalued to where we think they should be trading at. And specifically, examples like Game On and XR Immersive, we're working closer with those businesses, to get them back up. So I think that unlocking that value will benefit our assets, our book value. And the third is new portfolio companies. So we're really focused on the digital health space right now, and it's specifically because we've got a lot of key advantages, from distribution to physician and nurse network to pharmacy, a lot of key learnings that allow us to give us a big competitive advantage to build businesses within that area. And so I think that's going to be a third area where we're going to create a lot of value on our book value, but also I think cash flow for the parent company. Could you share more details on CEO share buys? So since February, I've been purchasing, roughly, I think around 5% of whatever the average daily trading volume is on the Canadian side. And the reason for this is, given that the stock is so thinly traded, didn't want to spike the share price and make our chart look, wonky. I think that really the consolidation at these levels, and like I mentioned, attracting a solid foundation of investors that really understand the VST story, from a long-term perspective and the underlying assets and value. With respect to purchasing, I will continue to buy stock, except for periods where I'm in a blackout. And I believe last week, I was in a blackout because it was leading up to the financials coming out. And I think I'll be in a blackout again in the last week of May. But apart from that, I'll continue to buy VST stock. What are you most excited about this year? I'm excited about a lot of things. But I would say Hydrate would probably be, the number one, again, because we own such a significant portion. It's tracking and trending really well. Solid team. I think that the flywheel is in effect there. And ultimately, I think it'll, in the short and long term, unlock a significant amount of value for VST and VST shareholders. So really excited about that, just again, given the momentum going on there. There are a couple of other things I want to just highlight too, and it's along the lines of the digital health sector. We really have built some strong competitive advantages in that space. The thing about health is that in a recession or in a boom economy or bad economy, health is a need, it's not a want. And so, given these advantages we have in this space and the disruption innovation that we can see, I'm excited about some of our new companies that are kind of launching in that space, specifically around men's health, women's health, and other types of vulnerable groups, healthcare services specifically for them. So that's an area that I'm excited about because they're being internally incubated. They're cash flow generating businesses, which again rolls up into the parent. And there's really no cost for us because we've already kind of built in these anchors. So I'm excited about that. We listen to what investors say about cash flow and all these other things, which normally the Victory Square business was more centered on NAV, but we have the capacity right now to increase our NAV, but at the same time generate cash. And so I'm excited about that. And the NAV growth again is another big one. I know a lot of people knock the NAV, but our business model is all based on cash invested and NAV growth over time, and the plan of continuing to compound that. So we see our NAV currently at a low right now of around 75 million, and just taking into account where we think Hydrate's tracking for this year, we see that ending the year at around 127 million. So again, excited to see that transpire. And sorry, lastly, the spinoffs. We have Stardust and Draft Label spinning off this year. So again, excited to see them list on their own. Does Victory Square ever consider taking more exposure to any of the portfolio companies? No, I think we're happy with our positions in the portfolio companies. Our goal is to diversify our exposure as the company grows. And it's also advantageous for those companies because we bring in other strategic investors to help the companies grow and scale even faster and onto that next level. So when we make our investments, we like to get a good position, but over time, we don't look to increase the position. We look to, kind of diversify our position and bring in other strategics to kind of help with the heavy lifting of getting those companies to where we think that they can go. What are 12 core focus companies? I would say that we have 10 core companies, and I would probably break them into two categories. So the first category, there are 6 of them, and these 6 are because we're more actively involved in the day-to-day business of these. And I would say that those are Hydrate, Victory Square Digital Health, Victory Square Health, also known as Safe Test Diagnostics, Discrete Care, Game On, and XRI Immersive. The second category of core companies, which we're involved in, but not as active on a day-to-day basis, I would say would be, Stardust Solar, Copilot .ai, Covalent CQT, and Fans Unite. So I would say those are really the 10 core. Not that the other ones are not important for us, but like really, these are the ones that we're more engaged with. Excuse me. Does Victory Square have any fair value estimations for the companies in the portfolio and its subsidiaries? So our NAV is broken into 3 categories: public, private, and incubating. The public ones are mark to market. So number of shares we have multiplied by the last share price traded. And in some cases, we take a discount just given that some of them are thinly traded. And that equals about 23.5 million roughly. The second is private, and these are third-party pricing agency and our auditors for the most part, in some cases management reviewed. These are probably closer to fair market value, given that the auditors have come in and looked and evaluated them. And I would say though that portfolio sits at about 42 million. And then there's incubating, which are kind of management reviewed. It's just we put a super conservative valuation on some of these startups that we're building internally, and we'd probably add all of the ones that are being incubated right now and total them at around 9 million. So collectively that is that's how we get to our $75 million NAV. Now, one thing to note again on the private companies, which I would say are probably the closest to fair value, given that like a third party prices them, pricing agency evaluates them, and our auditors review them as well, is the amount of information that is required for those companies to provide the third-party pricing agencies and the auditors. So just to give you an example, like these companies have to provide general update on operations for any given year, any changes in their business model. They have to update with updated investor presentations, strategy documents, details of financings, equity raises, internal share transactions, and proof of and documentation of, again, pitch decks that they would have used for financing, financial statements, updated financial statements for the most recent fiscal year, balance sheet, monthly income statement, for the past 12 months, a budget and a forecast going forward, summary of a cap table. So it's a pretty comprehensive list that both the third-party pricing agency and the auditors require these companies to provide to evaluate. In June, early June, we're going to be hosting another webinar, which we did one last year, which will be, again, all about the NAV. And in this, we will be breaking down the portfolio companies, the valuations of those portfolio companies, and the method of value and how we get the total numbers. And it'll also include the number of shares we have in those respective companies. And so investors can see that. We'll do that webinar in early June. This one looks like an angry question. You never seem to answer the tough questions, like getting the value of the core company higher. You have had time to show a strategy. Do you even have one? We would all love to hear that strategy. Do not tell us again, the market will turn. The market will only turn if you show a profit. And launching companies, how does that bring a profit to VSQTF stockholders if you do not buy back stocks? So good question. For anyone that's followed the VST story since inception in 2017, the business model and strategy has not changed. We buy, build, and invest in companies. We work with them for up to 48 months, and then we look to spin them off to unlock value for VST. And then we allow those companies to continue to grow and create further value for VST once they're spun off. And what we sometimes will do is, again, replenish the funnel. And to track this, we monitor our NAV. When we started this in 2017, the NAV was around 4 million, and we ended 2022 at approximately 80. It's obviously come down a bit to about 76, 75, 76, but that's a significant growth. Now, the share price has gone up and it's gone down along with the microcap space, almost in a direct correlation. But our NAV has continued to grow, and I believe we've been executing our business model. And I've always said we have no control over the market, but I can tell you the company has never been stronger. Yet the share price trades significantly lower than where we were 2 years ago. So we focus on what we can control, and we leave the market to the market. And, historically, the market's always gone up. In the short term, it's volatile, but in the long term, historically, it always goes up. And I've been buying stock, I mentioned earlier in an earlier question since early February, and I'll continue to do so. One thing I know that we can always do a better job of is our investor outreach and news releases. That's something that we just have to keep getting better at. Good morning. I know certain insiders have been buying on the open market, but I was under the impression that the company was going to buy back shares. Is this still on the table? We initiated a company buyback in 2021, but it didn't really have any positive effect. At that time, we felt that the company could better allocate its cash to growth. And then in 2022, we paused it because we wanted to, kind of let all the macro noise settle. And I feel like 2022 was this uncertain year with, all these, whether it was inflation and interest rates or, conflicts. And we just kind of monitored the market. But in 2023, I've been buying shares and will continue to do so. And I think, potentially next year, the company will evaluate a company buyback. I mentioned earlier, we're looking to build some internal cash flow generating assets. And so, if we don't see good growth opportunities internally within those businesses, we may use the cash to evaluate a buyback in 2024. What criteria would the company use to determine if the company should sell a position in one of the companies they have invested in? For example, the 20% ownership in the VSH business, what would cause the company to sell their 20% position? A certain percentage return on investment, cash needs, does the company have a predetermined exit point, or is it simply determined on the fly? So we have predetermined exit points for each company. It's very subjective to the company. However, we do have one general rule of thumb, and in most cases, that is that we like to first sell our cost base of whatever our initial investment was, plus 20% for each year we've held the investment. So in most cases, we like to do that again when the company's trading at a higher value or significantly higher value than what our cost base was. We like to recover our cost plus 20% return for each of those years, and that capital then can be used to reinvest into new opportunities. But we are long-term in a lot of these assets. There are some companies that we're more actively involved in that we monitor more closely. Those I'd say we're looking for something greater. However, there are companies that we're not as actively involved in that I think there's no necessarily rule or method, but we would look to lighten our positions in kind of in today's market, primarily because we're not really involved or active in those businesses. Company does a good job at limiting shareholder dilution by not executing financings too often. Will the company look to exit some of their other holdings in order to invest in more new holdings? Would like to understand how the company goes about thinking they will invest in additional businesses. Is it only when they see a business they like, or is it based on a company's cash position, i.e. ability to fund the purchase? Also, how many businesses does the company review as a potential investment in any given year? So at the moment, we're hyper focused on the digital health space for a couple of reasons. One, I mentioned earlier, we've built out a US nationwide network of physicians, nurse practitioners, pharmacy, all regulatory licenses and tech. And so this allows us to build these microsites that I mentioned, a women's health site or a men's health site that don't cost a lot for us to get up. We have all the underlying infrastructure to be able to serve, and they're cash flow generating businesses. And the other part of that is we're also able to supply, given that we have this wide physician and nurse network that can do virtual and at-home care services, and our pharmacy, our pricing is is unbeatable. We're able to also service and supply from a B2B perspective all of these other players in the market, whether they be virtual or bricks and mortar. They can buy their pharmaceuticals through us, or even leverage our distribution network of nurses or physicians. So really right now we're not looking outside of the health space. We're really want to keep focused on this and leverage our core advantages. And we don't need capital, so we're like sufficiently cashed up in these initiatives that we're working on, and we think will bring maximum value to VST. However, we get pitched every day. Like we probably see, I would say 100 to 150 pitches, a month. But again, like unless it's very specific and it complementary to what VST is doing in the health space, we don't really look at it from a Victory Square perspective. However, one of the great things now about having this wide portfolio is we do see a lot of deal flow that we're able, that it might not be something that VST is interested in, but one of the portfolio companies, it's a direct tie-in to that. So that's a big strategic advantage for us. The company's business model of spinning out businesses often means the future of VST's value is in the hands of companies they don't control, and is also subject to the whims of the market. Works great when markets are up, but we've seen a significant downturn in the market over the past 2 years, which has hurt VST's unaudited NAV. Any thoughts on how to mitigate the effects on VST of the down cycles of the market, given the effects of VST's NAV over the past few years? So, this is our business model. There'll definitely be companies in our portfolio that we have no control of. But I hope, those companies that we've backed, the right horses, and our process of finding these companies early, not being passive, but being active in helping, build them out, ensures that we're aligned with management. And it doesn't happen all the time. Like, there have been cases where the alignment has not been there. But, we try to also mitigate our downside risk exposure, given the low entry point that we generally enter in most of our businesses. So if you look at our history of the deals we do, we're coming at very, very low valuations, which again, mitigates our downside, risk exposure. And because we're involved in these businesses at that entry point, we know how to kind of extract value. And we've been able to do that in most cases, pre spin-off. So that gives us the best chance of success. And another thing about this portfolioed approach on the microcap space is that, given the whims of the microcap space, and the whims both ways, we've seen certain sectors get hot all of a sudden, whereas certain sectors will get out of favor, and that sometimes changes. I think given that we've got really good coverage in a lot of really great areas, which we believe are going to be big long term, whether it be blockchain, which is out of favor right now, digital health, AI, virtual, which is in favor now, virtual and augmented reality, which is not in favor right now, or climate tech, which is in favor right now, or sports betting, which is like middle favor. So I think this is this is our business model. We try to do a very good job at the beginning to make sure we're aligned with the founders. So even though we have no control over it, we're hoping we've backed the right horses. 2, our entry points are low. So, we're really trying to mitigate that downside risk exposure. But 3, this also allows us to have, really good balanced portfolio to manage the whims, kind of and cycles of the microcap space. Can you speak about any new startups that VST will be working on this year, and how many new ventures are expected this year? So we're hyper-focused again on the digital health sector and leveraging core advantages we already have. So we're currently focusing on incubating some startups. I would say there's probably 3 to 5 in the hopper in the digital health space. Again, around men's and women's healthcare. I'm excited about these again because I feel like their health is a need, not a want. So I'm confident in these businesses, whether there's a recession or not a recession. Also, we're leveraging competitive advantages, and there's a cash flow component to it. And one thing to highlight too is, a lot of tech words are, get thrown around, whether it's VR or AI or blockchain. The one thing is, whatever sector you're in, you're integrating a lot of this IP anyway. So when we look at some of our health related projects, AI is integrated and as is machine learning. So it does two things for us. One, it allows us to go into an area where we have a competitive advantage, an area that we think will continue to grow, that also incorporates, like tech and also again cash flow. The last part, which is important for us as we go through, whatever this next period is going to be, having our own internal kind of cash flow generating businesses. Oh, this is a tough question. What companies in VST's portfolio have the ability to weather a recession for 5 to 8 years? So this is a really, really tough question to answer because of the 5 to 8 year time horizon, but it is something that we think about internally. And what I can say with definitively is VST. So it's not a portfolio company, but the parent company can absolutely withstand a recession of 5 to 8 years. We've built it to be able to do that and to be self-sustaining. Outside of that, the best way for me to answer that would be that the core businesses, and I think I mentioned the 6 core businesses, those businesses, we spend a lot of time in, and so we have a plan A, B, and C to provide resources for those businesses to weather a recession of 5 to 8 years. Generally, in those types of time periods, it's a people challenge. It's not really all of those businesses are now at a point now where they're running fairly lean. They're at break even, if not above break even or close to it. But it's just sometimes the entrepreneurial journey is tiring for some going through that long cycle. But I would say that VST for sure can weather it. It's built to be able to do that. The 6 core businesses, we're actively involved in ensuring that they have the resources to be able to weather that. And even highlighting the digital health businesses, like Hydrate as an example. Health is a need, not a want. They've already built out all the core pieces that I can't see. They're thriving. If we're in an uncertain, difficult economic environment right now, they're thriving in it. So hopefully that answers the question. But I think VST and the core businesses, we would. Now, that's not to say that the non-core, anything outside of that can't withstand it. And we would work with those businesses, but I don't have enough data to be able to tell you convincingly that they can't. I believe they will, but that would be a question that I'm going to take back to them, because I think that is a great question just to for entrepreneurs to think about and be able to provide us some feedback on what they're thinking. This question, okay. I came across on the internet that VST is diluting shares from 20 million to 100 million shares as on today. When we have 100 million asset, why VST management would like to dilute more shares even in future? If they really need funds, we can liquidate a few percentage shares and one of the portfolio companies will do the job. It's not a good look when a company keeps on diluting their shares, especially in microcap stocks. This is absolutely not true. I'm not sure where this individual is getting his or her info, but we have 97 million shares out. There's no dilution expected. So I'm not sure where that information came from. Next question. When VST shares trading in deep discount, why can't VST management take a debit, sell a minor asset of 2 or 3 million out of $75 million asset and buy back 10 to 20% of the shares to increase shareholder value? This is a great question. So we tried a share buyback in 2021 and it had no impact. And it was a headache because the max we could buy, I think, over the course of a year was 5%, I think. And the process of buying was really, really difficult and costly. So we tried it for 2021. I think at the end of 2021, we decided that it was better for us to utilize our capital for growth. And just as an example, that capital that we utilized for growth in 2022 was Hydrate. We used that cash that we would have normally used for the buyback if we continued it to beef up Hydrate after post-acquisition. and pre-listing. And so again, we think we unlocked considerable more value for VSC and VSC shareholders in the long term by doing that. However, in the future, we may explore buybacks next year, company buybacks from these new ventures that will be generating cash flow. Next question. Since VST portfolio companies are microcaps, most of the companies need more time to stabilize themselves. In that case, is it fair to VST shareholders to wait for share cash dividend without an ETA? I'm okay even if you declare that VST can't be able to provide dividends due to macro conditions for the next 1 or 2 years, but need more clarity from the management. Like I said earlier, we like the dividend strategy. It just needs to be executed well. And like you referenced in the question, in order to, we need to give the company time to build up a profile as a public company. Because at the end of the day, we're trying to get maximum value for VST shareholders. And the best way to do that is to, give these companies a chance to kind of get their feet wet on the public markets. Especially the last 2 years have been really tough. Again, given the lack of volume on the microcap space and just the negative sentiment all around. But, we'll reassess. Again, I mentioned earlier, we'll reassess the dividend strategy at the end of this year. I don't anticipate a dividend this year. I do in the future, but not this year. But again, we'll reassess it and we'll communicate that to shareholders, on a quarterly basis and let them know how things are going. And when you think about a dividend, though, whether it be a cash dividend or a share dividend, in one of the earlier questions, there was a good example or comment in the question, which was, if the share dividends are a small amount and the shares and the stock and the companies aren't liquid, there's there could be the cost of trading that share could be costly to investors. And so really we want to maximize the value of these assets so that when we do issue a dividend, it's meaningful and valuable to shareholders. Next question, please share the plan for VST shares uplisting to the TSX and NASDAQ. So uplisting has been in our plans for a couple of years. It hasn't been at the top of the priority chain, and there's some criteria that we need to spend some more time focusing on that just don't make sense right now. So it's been in the plans for VST. It's just not a priority at this current time. However, what is a priority is we're most likely going to explore a TSX and NASDAQ listing for Hydrate next year first. So that's going to be the priority. I may be wrong, but we have to do these actions like buy back and cancel the certain percentage of stock, spin out dividend, reduce stock dilution regularly, which will give enough reasons to attract the new shareholders, and existing shareholders also have to be happy about their investment. We can add these positive metrics to attract more shareholders, institutions. I believe we have to keep our share structure tightly, just like Hydrate, to boost the share price. And considering the microcap space, please share your opinion on this. I do agree. Capital structure is really important. For VST, we have about 97 million shares out. I own approximately 15% of that. There's probably another 20% that's owned within the VST ecosystem, within the portfolio companies and their teams. Then there's probably about 15% in the hands of large shareholders total. And then another 15% in the hands of friends and family of VST. So that puts our float at about 35%, which would be roughly like 34 million shares. Now, of those 34 million shares, a third of them, or 11 million shares, came via financing that we did in 2022 at 52 cents a share, which I also participated in. And I still hold all my shares from that financing. And if you look at the market for the past year, it seems as if we've been consolidating at these levels. So we feel that the cap structure is fairly tight. It's been consolidating for a while. We're not expecting any further dilution. And what we've seen historically with VST in the microcap space is as soon as momentum comes back in to the space around certain sectors, our share price has benefited because we're in areas that have the tendency to get hot or gain a lot of attention quickly. So yeah, so we do have a tight capital structure, and I do agree with you. And I think again that structure will benefit shareholders when, whenever momentum and sentiment is positive again on the microcap space. How many employees working currently in VST? So we have a very, very tight team. We probably only have 3 or 4 full-time employees, including myself. And now, we're also, that same team is also actively involved in Hydrate and in some of the new health ventures. So we really, really have a great team and stretch that team. But we also have a number of subcontractors. So, our corporate secretary, CFO, and bookkeeper back office is all outsourced. So instead of keeping that in-house, we've outsourced it, and they're able to facilitate that for some of the other portfolio companies as well. And then we've got a really, really wide network of advisors and professionals in a variety of different areas. So I've mentioned this before, the head of BC Diabetes, or the director of University of Waterloo's Institute for Machine Learning and AI, our advisors. So we have a small core team, and that's why we keep our burn very low. But we have a really wide network of contractors, consultants, and advisors that are there to provide support for VST and our portfolio companies. So next question, since we have a lot of positive reasons on Hydrate's success, will VST keep a majority of its shares of Hydrate in the long run? Yeah, absolutely. Again, I've referenced this a number of times. It's our outlier. We really believe that, our goal is to get this, to continue that triple, double, get it to $100 million in revenue, and explore continued growth or a strategic exit. And we've seen consolidation in the at-home care market, which we think will continue. And the multiples are really, really significant in that sector and space. So yeah, absolutely. We want to hold the majority of our shares. We may need to issue out some of those shares to Hydrate management teams and on bonuses for consultants that we get to help on the file. But that would be insignificant in the big picture. Like we want to hold as much as we can. Next question. Since I'm from India, I've seen service-oriented IT companies getting bigger very quickly with positive EBITDA, and labor salary also considerably less. Average IT employee salary is $500 Canadian per month. Just an idea. Please consider if you have a positive opinion on this idea. Oh, absolutely. I mean, we currently use contractors in India and have been doing so for years. The talent that's there is unbelievable. And yes, the cost is significantly lower. So, we have developers here in Canada, in the US, in Brazil, in India, and we've been using talent globally. If the talent is there and the cost is reasonable and it's aligned with what we're doing, absolutely. India, just as a side note too, is we've been spending a lot more time on, because we see again within the health and sector and space, tremendous opportunities for growth in that market. And I'm bullish on India in general. So yeah, absolutely. Next question. Hydrate and Stardust Solar have a clear vision as to what they're going to do in the next few years. But in the case of VRAR or Game On, I'm failed to understand their vision. Even though Game On talks about profitability, couldn't be able to understand how they're going to do it in the long run. VR/AR is a black box to us. We don't know about their current work or product. These are really good questions, and I think that we should have a webinar with Matt Bailey, the CEO of Game On, and Shabir Sinalabi, the CEO of XRI, which I think we're going to plan for. Next week, I think we're aiming for Shane Madden for Hydrate, but in following weeks, we'll get them both on, because I think they would be the best to give specific insights into their respective businesses. However, what I can say with Game On, there's a lot of exciting stuff, around the corner. A couple of things, and just a note on them too, like they're navigating in a very challenging time within their sector. Their sector is very out of favor, if anyone's followed the sector, but they keep pushing along and putting up wins. So I'm confident in that team. Sometimes it's how you see a team navigate difficult times, more so than good times. So I've been really impressed with this, with watching how the team has navigated through challenging times. And one of the things about, the sector, whether it be gaming or Web3 sector they're in, those sectors go in and out of favor. And when they come back, what happens when those sectors go out of favor is builders keep building, fluff, gets kind of pushed by the wayside. But when those sectors come back, the builders that have kept building really benefit. And so again, I've been impressed with what they've been doing, but some specific examples, I mean, that they recently, anyone that's on their mailing list, they had a VIP pre-sale for this Karateka project that they had, which sold out within 2 weeks. I think that one project alone is on track for about $1 million in sales this year, USD. And I think the company itself overall is on track for about 3 million in profitability this year. There's some excuse me, there's some big IP they're going after that they're very close to signing, which I'll let Matt share with you, which would be game changing for them if they're able to convert it. So fingers crossed. And it could be an aha moment, catalyst moment for for their trajectory. And this, I mentioned Karateka and this other high profile IP. What it's also going to do is validate this Play Next platform that they've built, which is what this IP is being built on. And those tier one clients will, sometimes when you've got a working example or case study for a big client, it makes it a lot easier. The first sale is always a tough one, but once you get a couple under your belt that are quality and they've done well, it makes it a lot easier. So, again, their sales cycle should benefit from these two large projects. Long term, I think, I believe that the market will come back around that sector. Their float is still fairly tight. It's, there's not a lot of stock that's outside of, insiders or management or affiliates of the company. So it won't take a lot, to I think push that back up. But, in my opinion, I think that they'll be taken out in the next 3 to 5 years. I would expect that company to be acquired. With respect to VR AR, this is a tougher one. The latter half of 2022 was and the early part of this year had been a transitionary time for the company. We upgraded the board and the management team towards the fall last year. And a lot of work has been done cleaning up and clearing up a lot of legacy issues. However, the CEO and CTO, Shabir and Kamen, the product, this SVR platform, which came into XRI through an acquisition at the beginning of 2022, has been solid. It's growing. I think they're doing about $100K USD a month. If you take out the public market costs, they're profitable. And it's a lean team. And in addition to what they've been doing, we've been working on some really interesting VR and AR applications and new experiences that incorporate immersive AI experiences that we'll be introducing shortly. The VR AR structure is really, really tight. Even though there's probably 100 million shares out, I think I would say 85% of that is owned by insiders and management close to. So there's not a big float. And of the available amount, I think 10 million of those shares came from VST issuing a share distribution to our shareholders. So a lot of the work has been transitionary at this point. I know that there are things that are on the checklist for them, like getting their website updated, the deck updated, their socials updated, and most importantly, really improving their management's communication with shareholders. So, these are all things that we've, kind of had to go in sequence with them. But yeah, I'm confident that we'll, it's we refer to as one of our core assets. And so, I'm on the board now of that as well. And I'm confident we'll turn that ship around and improve, the customer investor communication shortly. Maybe I'm missing it, but can the company list somewhere the number of shares it owns in the various publicly traded companies they're invested in? Yeah, we can definitely do this. I mentioned earlier, we're planning a NAV webinar in June. And in that webinar, we'll walk through all the companies. So you'll see the number of shares in those companies, the valuation on those companies, the method that we use to value them and kind of the totals. So that'll be early June. Just keep an eye out. Next question. How have your meetings with family offices gone over the last 3 months? They went well. So Vahid and Shane, who's the CEO of Hydrate, presented in London to family offices from around the world, and they got some really good leads, which they've been following up on. Last week, the three of us, I joined them in Vegas for the Planet Microcap conference. And again, we met some really good family offices and some institutions, which we will be following up on over the coming weeks. And we'll start to be more active in these types of conference formats. It was really nice to sit next to an investor face to face and be able to share the story. And I think that hand-to-hand combat that we're prepared to do and travel to meet investors will, I think, be beneficial for VST Hydrate and our portfolio. I'm really sorry. I think I've gone over. I've gone over. I tried to get as many questions as I could. If there's anything missed, I will answer them over the weekend or early next week, and we'll post them in the Discord. We'll have a recording set up and hopefully dropped over the weekend or on Monday. Everyone, thank you for tuning in and all your support. Have a great weekend, and go Leafs.